Hi, I'm Jared Nelson from the Investing Channel, and welcome to The Spill. At the start of 2021, PayPal traded just north of $300 per share. But today, it's barely holding above $100 per share. That's a haircut of more than 65%. Right now, the company is worth as much as it was when it generated $15.9 billion in sales. Except it currently makes $25.3 billion. Its recent quarterly results sent the stock tumbling nearly 40% in a matter of days as revenue growth slowed. But does that create an investable opportunity? Amongst financial services stock searches this month by financial pros, PayPal led the pack by a mile. This stock has seen more interest in the last month than the last 3 combined. Taken together, we wanted to know whether this created an investable opportunity for bottom fishers. PayPal is a payment and money management platform that in recent years has expanded to include digital wallets, cryptocurrency trading and payments, as well as the Venmo app. The stock's recent decline was driven primarily by slower growth. Total payment volume surged during the pandemic, sending shares skyrocketing. However, recent growth rates slowed to 23%, with guidance for 2022 at 19 to 21%, with net revenue growth at 15 to 17%. That is what caught investors' attention. On top of that, there has been a decline in account growth as well. The good news is the company's Venmo mobile app is helping drive transaction growth, competing directly with the likes of Square and other payment providers. And looking at the financials, let's start with a dose of realism. PayPal is an incredibly profitable company that isn't going bankrupt anytime soon. The company generates more than $5 billion in free cash flow annually and expects to get near $6 billion in 2022. That's more than $5 per share in free cash flow. Now, detractors are correct in pointing out the higher expenses and declining margins over the last several quarters. But at the moment, PayPal operates at a 17% operating margin. However, the company believes it can expand that to over 20% by 2025. Growth is slowing, not stopping, and the company has ample cash on hand to spend on acquisitions and development to bolster growth. And when we look at valuations, PayPal comes in pretty cheaply compared to its peers. In our opinion, this is an 8 out of 10 ranking stock. And while PayPal could crack $100 per share, given its growth and reasonable outlook, paying 20x cash isn't a bad proposition. Payment processing is a big business that is set to grow with more volume shifting online. Yes, it's a competitive environment. But PayPal has the name recognition and global reach Square doesn't. And simply put, it has better technology for mobile and online payments than Visa or MasterCard. Click and subscribe to the Spill newsletter to get the full breakdown.